very lyrical.
It is. It really is.
Yeah,
There could be a melody associated with it. Yeah.
I'm trying to restrain myself from...
No, I want to sing, but nobody wants me to sing right now.
I'd like to hear you sing.
No, you really don't.
Swift-
I promise.
Swiftly moving on.
Swiftly moving on.
This week on the VC React podcast, we're here live from Money 2020 Middle East in Riyadh. We will break down the vibe in here, what feels real, what feels just noise, and what trends are actually shaping the future of fintech in the MENA region. Then, we will discuss Tamara just locked in $1.4 billion in debt. Yes, with a B, from Goldman, Citi, and Apollo. Is buy now, pay later finally proving it can scale sustainably? Or it's just a high-stakes leverage play? Hala raised $157 million Series B to scale its SME payment, banking, and finance here in Saudi. Is this the square of MENA? Or is the fintech bundle getting too heavy to carry? And finally, Robinhood wants to open startup investing for everyone. A public fund for early stage startups. Good idea or a recipe for a bubble? Hi everyone and welcome to a new episode of the VC React podcast. Every week we bring you reactions and insights from top VCs, LPs and angel investors reacting to the latest news on startups, fund and investment rounds. Let's jump into it with our amazing guest for today. We're waiting for the second guest, Armineh Baghoomian, Managing Director, Head of EMEA, Co-Head of Global Fintech at Partners for Growth. And the second guest will be Nichole, Managing Director at First Rate Ventures. And of course, my co-host, Jamie Lane from FWDstart. Our weekly news are brought to you by FWDstart, a twice weekly newsletter that breaks down what's happening in the MENA startup, VC, and tech space. What do you say we start with quick reactions to Money 2020? What stood out the most for you in this event this year? A talk, a company, a trend, or maybe something in the hallway?
For me personally, I think it's the entire event. There are some specific things and sort of structures and stages they've set up that I particularly like, but I was a massive fan of this event last year. I don't stop talking about it. It
was Fintech 24 last year.
It was 24 Fintech last year, yeah. It sounds kind of performative. The way I talk about it is a little extreme because honestly, it was the best conference I had been to in the region, and that continues this year. We're very Fintech focused, and so you don't often see a collection of the ecosystem in one place like this. It's just incredibly helpful and productive. It's why you see a large number of participants on the third day of a conference. That doesn't often happen.
I expected it to be
exactly.
Yeah.
It usually weans off. People are like, okay, I went for day one, and day two was great too. Now day three is home. So it's constant. There's a really good flow, super constructive conversations. We've had a number of really good opportunities come out of it last year, and this year will be the same. So the entire event is fantastic. I love the off-the-record stage that they set up this year. I know you
really good.
Guys have. Yeah, it was so good. I was lucky enough to do one session in there. I just think it's it's just chill, informal. It's set up like a lounge as well.
Which helps.
I know, right?
It does. Yeah, absolutely. It's conducive to, that sort of
exactly.
Which,
so you feel like you can say whatever, and I did, and so hopefully it is off the record, but it was great. So I love that. The panelists they've brought in, I've talked to a number of people. It's their first trip here to Saudi and to the broader region. They're all super enthusiastic. Couple were talking about extending their trip just to kind of go and tour around and experience the city. So in general, it's just productive. Good themes, consistent themes, amazing participants. Regulators are here. There are constructive conversations between companies and the regulators.
Did you get any popsicles?
This popsicle situation.
Okay.
I don't understand because I have seen an unusual and unnatural number of popsicle posts on LinkedIn.
Oh, really?
And I have not seen a popsicle.
Neither have I.
Like I've not.
Yeah, me too.
Honestly,
Brittany last night, she said that she had a popsicle from here, so.
I'd love one.
No, I saw some really good pictures of people getting a popsicle, enjoying a popsicle,
Oh, very
walking
unfair.
around to the I haven't seen them. I don't know where they are. So.
Okay, usually with these big events,
Yeah.
hall 1 would be for government, hall 2 would be for banking and insurance companies, and hall 3, this one we're here today in, is for startups and VCs. Have you noticed any new trends this year in the startups? Are they focusing on something new that they have not focused on last year?
Look, I think the themes are pretty consistent. There's more structure around what companies are doing and how they're doing it. And it just feels like there are more international eyes and participants in the ecosystem. I don't know if you guys agree, but it's just, it's more, there's more structure coming around the kinds of products. There's more structure around the frameworks in terms of how those products are deployed into the market. It's reflective of the maturation and the speed at which the market is maturing. So that I'm getting a sense of. I have been cornered in various places in the conference, so I haven't had a lot of time to figure out if there are some constant themes, but a lot of it is around the same major theme, which is to kind of introduce missing financial products and services.
Filling in gaps.
Yeah, fill in gaps into an incredibly digitally forward economy and population. And how do we do that? And how do we do that quickly? And how do we do that responsibly? And so it's more of the same, but just kind of it's maturing everywhere, every year dramatically, I would say.
Well, okay. Today we have 3 stories to cover. Hopefully we can get to all 3 of them. Jamie, please.
Yeah, I mean, look, I think we kick off with Tamara, and hopefully be able to lean on you on the debt facility side of things and get your perspective on that. I know technically a rival to portfolio company Tabby, but you know.
Look, credit does not look at, there's no rivalry, right?
True.
I mean, you should think of credit, it's like a bank can work with multiple clients that are in the same sector. We're not, aligned to anyone. We often work with multiple players in the same sector. We have, for example, 2 of the buy now pay laters in the kingdom on in our portfolio. So I'm excited about the category. I think both companies are massively successful, and it's a large enough market for both to succeed in a profound way. Credit in general, I'm excited about, and the way these businesses use leverage. They have to use leverage. It should be a minimal equity structure kind of business. They need a lot of leverage. The fact that you have very large international players coming into the market is huge, right? I mean, that wasn't the case a handful of years ago. So it's just a big testimony to what these companies have done, how they've gotten there, the general market opportunity here. It's incredibly resilient. Sure. It's safe space for me personally coming here. So, watching these companies continue to kind of benefit from all these different products in the capital markets and their options and stacking them properly to scale their business is a huge success. So
she's here. We talked about her before, but Nichole has just joined us now. Thank you for joining us.
So happy to be here. Thank you.
Jamie, would you like to give us some context on the Tamara deal?
Sure. Yeah, absolutely. So the deal, $1.4 billion in an asset-backed facility. Big name players involved. You have your Goldman, who previously would have backed to the tune of 500 million previously. So they've refinanced and they've extended this. You have Citi involved as well. You have Apollo in the mix. So look, it's a colossal amount of money, needless to say, potentially rising up to 2.4 billion in due course as well. So look, with that in mind, I'm keen to get your perspective. I mean, in terms of given, I suppose, the position as a global fund and having maybe the exposure in terms of the US context and seeing what's transpired there on the buy now pay later side of things with your firms, your Klarnas, etc. And I know you've backed Tabby. Like, would you have anticipated buy now pay later to be as successful as it has been in the Gulf?
So on the surface of it, if you just looked at it category wide, you would not. You would just think, okay, this is going to have the same kind of margin profile as it does elsewhere. We have the benefit of doing a lot outside of the U.S., right? So we're quite global. A lot of our portfolio sits outside of the U.S., and we see these models everywhere. That doesn't mean to say that they're more profitable anywhere else, but we understand that you have to be very careful about understanding local cultural nuances and economics and everything else, population dynamics, credit card deployment and penetration, things like that, to understand that it could be different. And that's what we saw. We came in between their seed and Series A for Tabby, that is, and we saw that, we understood it, and we're happy to kind of help them scale and ride that bet, if you will, and it worked out. So it does not perform the way it does here elsewhere. It's beautiful. This market, it's a stunning product.
Oh, it really is.
And you can see it through the success of these businesses for sure.
Yeah, no, 100%. I think even comparing it to Klarna in terms of obviously the public debut last week as well, and 20 years to get to that point. And
Exactly.
Then Twitch tab.
I mean, look at the pace. It's ridiculous. It's
insane. Yeah,
it's literally
it is
insane.
Yeah.
And so I think you have to be very careful. We were questioned 1,000,000 times when we did the first deal. 1,000,001 times maybe, and it was all kind of, what are you thinking?
Skepticism.
Yeah,
in terms
exactly.
Of, yeah.
What do you see that we're not seeing? And so that required being on the ground, understanding things, and kind of really taking a data-driven view of it.
How about you, Nichole? What do you think of this deal?
Well, I think on the face of it, my firm, I'm a CVC, so we focus specifically in wealth tech, so we don't have as much domain expertise in sort of the payments space and the lending space. But I would just say, taking a step back, having experience negotiating with lenders like this, the fact that they have underwritten this deal, these are very top tier banks that have done that, sort of speaks very strongly to the position that they're in, the book that they've built, kind of their rates, their take rates. So I think on the face of it, it looks like a very positive step. I think the things that come to my mind for kind of what's next for them would just be, can they maintain these rates, and what is that growth going to look like going forward?
Yes, that's what's really interesting for the category here, because they have the benefit of how these businesses have evolved elsewhere. They understand the compression of margins. They understand what happens right to the economics. So they start from a better position, and they have the time and knowledge based on other companies' scale to think about how they migrate products, how they add products, how they kind of diversify what they do. I think they're in just an incredibly powerful position. They're going to be incredibly successful, I have no doubt. I could probably make a bet on that.
Yeah.
You could.
We have.
We did already, yeah.
We have, yeah.
Quite literally.
I guess we have.
Okay, so you mentioned that having debt for
Yeah.
this company makes sense because
Yeah.
it's part of their business model. But what risks should Tamara or similar companies should they consider while having such a big debt amount in the companies or in the capital structure of the company, being such a still early startup relatively?
Yeah. So I think that the most important things, and this is what we focus on when we look at these deals, any company where we're doing our asset-backed, we mostly do asset-backed facilities, they have to really understand the data, right? They have to understand their consumer, their end client. They have to understand the data. They have to understand how that product really behaves. And that's at a very granular level. So what does that mean? You got to be all over the data. And these are things that cycle quickly. And the transactions are measured in millions, right? It's not 2 or 3 a month. You really have to have systems in place. You have to have the right people in place, the right skills in place to be able to do that. You have to have capital markets expertise, because you have to understand what these structures look like. They're non-trivial. To your point, the process that they have to go through just to get these large institutional facilities is non-trivial in and of itself. You have to have the know-how and the data, the visibility into what you're doing to be able to handle that well. And I give the companies that have done that successfully in this region a huge amount of credit, because they've had to come up to speed, and you're measured in less than 10 years, right? So significantly less than 10 years. That's huge kudos.
That's amazing.
Yeah.
Nichole, have you seen startups at this stage having such a big amount of debt?
None that we have underwritten, personally. But I would just say, again, as somebody who interacts with our own financing, in terms of the risk that you're taking on, especially with a product like this, it's D2C, you have a number of things happening, right? You have the fact that just the nature of debt being pretty rigid, right? Yeah. So you can have the best growth paths, but, have they modeled out all the different downside scenarios and kind of manage their covenant obligations in order to give them some flexibility with that? You also have to think about the changes in the volatility and the cost of capital. We don't know exactly what the terms are that they have, if it's a fixed rate, or I'm assuming it's floating, right, based on prime or SOFR or something along those lines. So, that could change as well, which can have drastic impacts. And then also you just have, in general, the impact on household incomes, right? And so in a macroeconomic environment where there's still a fair amount of flexibility, things seem to be normalizing, but it's still, to my view, there's a lot of possible changes that possibly households may not expect.
Yeah.
So how might that impact, people's ability to pay?
I mean, this isn't permanent capital, right? So that's the biggest stress point. You got to pay it back. So making sure you understand that and you understand all the underlying obligations, and then understanding how your product is going to be affected by those obligations or affect those obligations, or, I mean, to your point, super important.
I think on the data side of things as well, I would recommend, if anyone is interested, that Tamara have started publishing publicly quarterly financial reports as well, which I think is quite interesting in terms of getting that insight into, exact breakdowns of their, on the cohort side of things. I think Tabby are doing something similar as well. So they very much are sort of, driving that path towards the eventual IPO. It's very
They're
clear
preparing
that
their
is
the
absolutely
fans of the company to, read
no doubt.
more about the insights of the company.
It's exciting.
It is exciting.
Well, let's keep it moving. What's the next story?
Let's talk about Hala, which you told me last night was formerly Halala?
Halala.
Halala.
Used to be Halala,
Was?
and then they changed the name to Hala.
Hala, that sounds like a song.
Halala is like the penny and the Saudi riyal.
Oh, okay.
That's cute.
Yeah.
You could have a nice little sing-song to it.
You
like
could.
that.
It
They actually
does-
started as a payment company, a QR payment company,
Oh, interesting.
B2C. And then after, I
Yeah.
think, 3 years, they pivoted to the new model,
Okay.
B2B.
Well, they could have had a jingle with the former name.
It's very lyrical.
It is. It really
Yeah,
is. There could be a melody associated with it. Yeah.
I'm trying to restrain myself from.
No, I want to sing, but nobody wants me to sing right now.
I'd like to hear you sing.
No, you really don't.
Swift-
I promise.
Swiftly moving on.
Swiftly moving on. Yeah.
But yeah, Hala, they've raised a $157 million dollar Series B, which is colossal, needless to say. This has been sort of in the works for a while, I would say, in terms of being disclosed. Like it first came on my radar that they'd raised from TPG last May 2024. I think the information reported that they had sort of deployed some amount of capital in. But as you mentioned, Ahmad, formerly a B2C play, I think they were one of the first sort of like peer-to-peer payment platforms in the kingdom, sort of had like a digital wallet, and subsequently moved on to the more, the nicer, the B2B side of things. I think things really accelerated, I think, from that point.
Yeah.
I think the last raise, equity raise, it was 2021. I think Impact 46 led that. I think it was 6.5 million, or something to that effect. But this is orders of magnitude larger, and a massive amount of investors, both joining the cap table, and obviously you have existing investors doubling, tripling down again.
Did you count like 10 investors joining the round? Or?
I've lost. I can't even count that high.
I think you can go higher than 10.
Can't even count that high.
I have confidence in you too. I think you can.
Well,
but
okay,
I
so-
did see the LinkedIn post, and it was many lines.
Many lines.
I think we will mention them all in our LinkedIn
You
post.
probably
as well.
should. Yeah, probably should.
Many lines.
Yeah.
Well, it's a $157 million Series
Yeah.
B. Compared to the US, is it high, low, or just average for a Series B company? Before we get into the details of the company, about the raise itself, the amount.
I mean, I'm a credit person, but I think you've seen all kinds of sizes of raises. I'm not fixated on that as much. I think that's amazing. It's another example of having incredibly high reputation, international equity funds come in and participate in the ecosystem in a very meaningful way, right? You've got TPG and QED and that's huge.
Yeah.
Not only for Hala, but for the ecosystem. I have a funny story about Hala.
Yeah, please.
Go on then.
I like them a lot. They're great. But I've gone to their offices multiple times to meet with them. And they have two entrances. And one, well, I thought were two entrances, but one is actually a line for merchants to pay their bills, and one is an entrance for meetings. I often stand on the line for them. So I wait there on a long line. I'm just waiting.
Why?
I don't know. That's a good question. It probably says more about me than it does anything else. But yeah, they're great. I'm really excited for them.
Amazing.
And again, it's, great investors coming in to build a business. Yeah.
Nichole?
Yeah, I would say in general, if we make some assumptions about their market penetration and their take rates, it seems fairly reasonable to me. Again, I think there's a bit growth assumptions built into the valuation, of course, as well. So I think it does raise the question in terms of, as you mentioned, the compression rates that might be accomplished or experienced over time. What is that going to do to the business, and sort of what is their plan to leverage the share that they've built so far and those relationships to build something that's more durable and higher margin that will stand the test of time.
I'm trying to compare them here with Square in the US, because Square started as a payment company and then evolved into bringing SME banking and then financing and loans. And it seems that Hala is taking the same path. Started as a B2C payment company, then started offering bank accounts to SMEs, micro and small and medium enterprises, and now they're into financing. Do you think the same story can work here too? Like the success of Square can be replicated here? Or is there any differences that you can, draw our attention to?
So look, fundamentally, the what are some of the opportunities here, right? It's still a relatively underbanked ecosystem, whether you're looking at consumers or SMEs or anything else, any other category you want to capture. If they have a captive set of clients and customers, which they do, they have an amazing, penetration of the SME
150,000.
It's amazing, yeah. So why not figure out how to supply that same customer base with other products that they may need that they're not getting elsewhere? And by the way, they're in your ecosystem, and you have them captive in your ecosystem, and the transactions are visible and stuff like that. So
you think that would distract them?
Well, look, at the core, you would be best at answering this, but you want to make sure your core business is built and it's sustainable, which they've done. They've been doing that for a while now, so it's a scaled, sustainable business. You start adding things to complement. That's typical from my experience.
Yes, I would say I'm a big fan of this framework called Hamilton-Helmer's 7 Powers.
Oh yeah,
you guys heard of it?
Big fan.
Okay, so I think
I didn't. Please elaborate.
You need to listen.
Everything
you need
through
to
this
listen to
lens.
Acquired more.
Yes.
Okay.
Oh no!
I'm a big fan of Acquired. Okay, I may not get them all, but there's a few that are relevant here. So there's process power, which is really just that you have some kind of ability within your company to do something in a different, significant way that builds durable, lasting advantage. Cornered resource, which would be some sort of data or asset or capability that others in the marketplace don't have access to. There's network effects, scale economies, So in this situation, and if you compare it to the situation with Square, per my understanding of what happened with Square, they did start off in this transactional space, which is very thin margin, and that sort of got them to be on the scene, right? Sort of be able to capture those customers that they can then build on that relationship. And then what they did from there is that they realized that they have this unique opportunity to understand the data of their customers, which are these businesses, right, the SMEs, that helps them to understand these companies in a way that maybe even their banks don't, and then be able to build on that to offer other products that are higher margin, like the working capital loans that they have used. So in my mind, through like this just durability lens that I take to reviewing companies, is what is Hala's opportunity to do that? And it seems like they do have some similar opportunities in this space. It may not be the exact same adjacent solution, but I do think there is an opportunity for them to build on those sticky customer relationships and cross-sell other solutions to them.
They already have them. They're incredibly sticky.
Yeah.
I found out on the line with the merchants. They love it.
Well, when you're an SME, I've done some sort of side consulting with some of these businesses back in the day, and you're just managing so many different aspects of the business, and managing your working capital and your finances is usually not their favorite part.
That's right.
To be honest. So if they are happy and they're being able to leverage other insights, for example, this company that I did consulting with, they realized they were able to establish a loyalty program, offer incentives, really increase the lifetime value of those customers through just using this transaction app, which is not even the reason why they picked the app, but as they were able to continue to layer on those sources of value that were easy and just seamless for them to leverage, it was a no-brainer for them. So I would envision the same concept.
Yeah, that's the right. Those are the right words. It's a no-brainer from my perspective. I mean.
Okay, so a naive question here. They started kind of fighting banks. They're offering banking services to SMEs that usually banks do not offer the same services to. And now they expanded into financing. And I'm sure at some point in the future, they will need some big credit or debt from those banks. It's ironic somehow. They will go back to the banks to get those big debt or debt facilities to give to the SMEs later on. Is that ironic, or what do you think of that?
No, I mean, I think it's kind of a normal evolution of any market, right?
So they will not replace banks.
Look at, I'll give you the example of Tabby, which is the deal that we did. Different sub-segment, but similar evolution. We provided the first credit facility there, right? When nobody would have.
Yeah.
The banks would not have considered them, right? At that time, 5 years ago, it was you need 3 years of profitable bank statements, you need this and that and the other thing. They just wouldn't have done it. So the reason funds like ours exist is to fill that gap. Similar to the reason these companies exist, they're filling a gap that larger institutions cannot. They do not have the bandwidth to think that granular. They're looking for like large ticket, productized services and products they can deploy. Now that changes, right? Tabby evolved. We grew the facility to $350 million, and then it was refinanced by a bank that is happy to look at a very large facility, and JP Morgan came in. And then what do? We moved to help finance products that JP Morgan's not comfortable doing yet.
Okay, so you're saying there's a segmentation in the market.
Exactly.
Some segments can be served by venture debt companies, by, smaller fintech startups who are filling that gap, but then banks will eventually look at this.
They'll eventually
area.
look at it. It'll become a large enough market, and they'll say, okay, we need to really address this as well. We can do it directly and more cost effectively. And then these businesses look at other sub-segments that aren't being kind of filled by the banks. That's just kind of the natural evolution. I don't know if you agree or...
Well, I have an interesting perspective on this because we work with half of the top private banks in the U.S. for our core business. And what I hear constantly is that, banks tend to be very siloed as well. So my guess would be that the underwriting department for this would really just base it off of the fundamentals of the deal and not have concerns really about competition.
No, they wouldn't. I mean, at some senior level, strategically, there would maybe start get concerned about one thing or another. Yeah. And then they'll figure it out, and then again, a business will fill another gap. There's just always that cycle. Otherwise, funds like ours wouldn't exist, right? Yeah. A private credit fund like Partners for Growth wouldn't exist because the banks would do all the deals. Well, they don't have the patience, the appetite. It's highly customized. It's the same dynamics you see over and over again.
There are increasingly different and creative financing options out there as well.
Exactly.
Before we move to Robinhood, I noticed something. Please just give me your feedback if you've noticed that as well or not.
About how fantastic we are.
Yes, you are very fantastic, and thank you so much.
I just want to be clear.
So, a first wave of startup companies, they wanted to replace banks, to replace insurance companies, to replace traditional brokers like Robinhood. And now I'm noticing in here, some companies are white labeling that technology that, for example, Robinhood created and selling it to traditional brokers. Some companies are white labeling debt products and selling it to banks. So it seems that the second wave of fintech startups that at least I'm noticing here today, they're trying to help the disrupted ones or enable them to fight back the disruptors. Have you seen that? Have you noticed that trend or not yet?
You mean here or globally?
I've seen at least 5 companies
doing
white labeling here.
Yeah.
And I don't know, globally, have you seen that globally?
Yeah, because, okay, what are startups typically doing, right? They're patching an inefficiency or a product, some gap. There's some gap, right? Somebody's being ignored. Somebody's not getting what they need. They're still worthy of that product or service, but they just don't have access to it. And so they start providing it, and then there's kind of an awakening because they become the disruptor. They're taking somebody's market share or taking an opportunity set that somebody else didn't realize. And then that somebody else decides, well, I'd like to do that as well. but I don't really have the sophistication or underlying sort of appetite for the granularity of whatever that is. Then there are companies that are developed to provide that infrastructure, right, as a service effectively, or a platform for these large institutions to be able to get in the market. I mean, I think you see that in a lot of places, but I have noticed that here.
Yeah.
Definitely.
There's a lot of white labeling services, or startups at least.
Yeah.
Well, moving on to Robinhood. What's new with Robinhood?
Yeah, I mean, look, they've been on a tear the last 12 months. Like the stock is up 300%, something to that effect. Like it's insane. Vlad, it's like my first name basis.
No, obviously,
him,
I mean,
you know,
clearly, good for you.
But yeah, they've been doing amazing. And if you want to own a slice of SpaceX, if you want to own a slice of Stripe, if you want to own a slice of, I don't know, any other private, OpenAI, for example, he wants to facilitate that, it would seem, much to the dismay of many of the founders and CEOs of these private companies who are purposely avoiding going public. But yeah, they've established a venture fund to acquire parts of these companies, and then they're going to offer them sort of like a tokenized basis via Robinhood moving forward, which is an interesting development. Obviously, we've seen a massive plummet in terms of companies going public in the US, although pretty good time to go public given, you know, recent Circle, or if you're looking at Figma. I mean, you know, stocks have been popping, but obviously there are those large companies opening. I mean, $500 billion company that's still private is sort of extraordinary.
My understanding was that this fund will be for earlier stage companies. Is it, or is it for big companies with secondary deals like Destiny 100, for example, or?
Yeah, I'm not 100%. Truth be told, I mean, I don't think any of these companies want their sort of shares, and they sort of experimented with this, I think, earlier this year as well, and they've tried something like tokenized in the EU and in Europe previously too. They're walking a fine line to a certain extent. I understand in principle what they're trying to do, but I'm uncertain as to how it all pans out.
Yeah, it's a very interesting opportunity, and we do invest in this sort of private markets access space. So I would say there's a lot sort of to be unveiled about how they're actually going to make this happen. So to your point, I was also not clear on which stage they were talking about. But I think there's also a lot of complexity just coming from the CVC early stage investing side of things. If you think about the variety of different kinds of terms that would be a part of what is acquired here, you know, it's not just like a common stock share, right? There's a lot of different really values of the combinations of those terms that are really going to be complicated to transfer to a simple model, I think they're trying to deploy. And also there's a lot of sort of disclosures and education that would need to happen, I would think, for them to do that responsibly. So I think some of that just needs to be sorted out. I'm sure they're working on it. But that's where I'm going to be very curious, is just to watch, to understand further how they're planning on deploying this in places outside the U.S. So that it can eventually come to the U.S. And I think there is a lot of appetite for it. I think I would say I'm really bullish on the opportunity of it and in concept, but the devil's going to be in the details.
Yeah, 100%.
100% agree. I'm all for the democratization of access. But yeah, the underlying nuances, I'm just glad it's not my job to figure out.
In general, we went from AngelList to then Republic and WeFunder and all of these equity crowdfunding platforms, and there's some debt crowdfunding platforms, and then now Robinhood is getting on that wagon. Is the future of VC going more towards the masses, towards the crowds, or will still institutional investors will still win the game at the end of the day?
Well, my take on that is that I think institutional investors still add a lot of value to early stage companies because they really understand the nuances of the business models in a unique way, especially if they're, targeted to a sector like we are. And also, they can also do follow-on rounds. There's just a lot of value that they can bring to the table. But I also believe that sort of the retail investor will, over time, I think it's just inevitable that's going to be just a more part of the landscape and what people consider. I mean, you can already see that crowdfunding is an accepted and readily available option.
Yeah, I would agree. I think it, and I like it. I just think there's a lot of education, to your earlier point, and regulatory frameworks to make sure it's done in a responsible way. But I think institutional will still be the larger piece of the pie, but they'll be significant contributors as well.
Have you heard of Destiny 100? It's a publicly listed fund that's evaluated by the assets, the underlying assets, and the underlying assets is basically shares in those 100 private companies in the US, including SpaceX and, you know, all of these big names. First of all, what do you think of that model? And second, would something like this maybe work in the Middle East region, in Saudi, publicly listed fund that owns secondary shares and big names, big private companies?
I mean, I think it's a good opportunity. I don't see why, if it exists somewhere else, it wouldn't exist here. I think the secondary market in general is super interesting, and given the lack of liquidity elsewhere, in some cases, somewhat necessary. I don't know enough about that model to opine on it, but I don't see why it couldn't exist elsewhere.
It's listed on the NASDAQ stock exchange.
Yeah, I mean,
Interesting. Okay. Yeah, I mean, my only question would be, there seems to be very robust and differing regulatory frameworks in this region. I'm still learning, so you guys would probably know more than I do. But my question would just be, you know, are there any obstacles inherent in those regulations that would allow it, that would prevent it from coming here? But there again, I still believe that people tend to find workarounds. So if there's demand for something like that, I can imagine that it will come to pass.
Yeah.
Okay, my last question.
Yes.
No, you have to go. For the cap table, as an investor in startup companies, do you encourage founders to innovate in their cap table, bring in crowd investors, secondary investors, or do you think this is just chaos?
Let you go first.
No, you go.
Okay. You know, because we're a CVC, we think very differently. You know, we're looking for some kind of combination of what the startup wants to accomplish and our assets or capabilities. We look for an opportunity where us being a part of their team, essentially partnering with them, allows them to either de-risk or to be more capital efficient or go to market more quickly. And the other thing that we really prefer, that we actually underwrite for, is optionality. We'd like our founders to survive to fight another day. So I would say, and we tend to not take a board seat, so we don't usually have these conversations. But to answer your question, I think there's also, you know, I would encourage the founders to think about what forms of financing are going to allow them to do that. So I think we would be supportive of anything that's going to allow them that flexibility to pivot, to form partnerships, and to just extend their runway so that they can really kind of have enough iterations to make sure that they find the right fit for them long term.
Yeah, and I think for us, we're credit, right? So, and we definitely don't take board seats. There's a bit of a conflict there. But for us, our one of our principal philosophies and theses and sort of mandates is to obviate the need for entrepreneurs and founders and early investors, frankly, to continue to dilute themselves and if they can, you know, sustainably and responsibly take debt and credit, right? That is our pitch. Right? You can expand your underlying business. It is good collateral. It is leverageable, and therefore you don't have to raise that money in equity, and it kind of simplifies the cap table, certainly from that perspective.
Anything else we didn't ask about you would like to mention?
I don't know.
It's a big question.
Where I'm going to get my next cup of coffee.
Okay. We can help you with that. Well, with this, thank you so much, Armineh and Nichole, for joining us today.
Yeah.
It's been a lovely conversation, and we'd
Super
love to have you again soon, but I can't promise that it will be as fancy as this one.
I'm going to
I
manifest
promise you
that.
it won't be.
No. I'm going to manifest it for you.
Okay,
I'm
thank
gonna
you.
mentally manifest it for you. I think you guys deserve this setup. It's great. I don't know about the this thing, the money pot thing. I don't know where you'd put that between your two locations, but at least get the mic and the headset stuff.
Yeah.
I'd like to thank Elizabeth from Tahaluf because she organized the whole thing and helped us to get this place. Thank you so much, Elizabeth.
The entire team of the organizers here have been fantastic, by the way.
I'd like to thank my parents for birthing me.
Wow. Okay.
Well, thank you so much.
Thank you guys.
Thank you. It was
Thank
super
you.
fun. Thank you.